أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome to chapter 10. We're going to start a chapter today that is very uh, similar to the chapters that are going to come after this. So the format of the chapter that we're going to start today is the same as all the chapters that are going to come after this. So it's very important that you understand the way we are going to discuss this chapter and the content. If you can get a very good handle on chapter 10, then the following chapters are slight variations of what we are going to discuss. In this chapter, we're going to discuss two aspects. The first aspect is what the client does. So we're going to try to understand what the client does to operate the business, and then the steps in the operations, and then we are going to understand how they record the items in the financial statements. So this is the first part, understanding what the client does. And then in the second part, we're going to we're going to try to understand, inshallah, what we are supposed to do as auditors. Okay? And this particular part, this particular chapter deals with the revenue process. If you have been with me in Accounting Information System, we studied a chapter called the revenue cycle. It's the same part of the business, revenue cycle or revenue process. So let's start. The first thing we need to understand is the objective of the client. So remember, we're trying to understand what the client does. The client's objective in the revenue process of the business is to sell goods and services and collect payments. So their goal is to sell what they produce or sell the service if they're a service providing organization and collect the payment. So this is their primary goal. There are two types of transactions in this business process. The first type is sales. The sales can be cash sales or it can be credit sales. Here, credit sales does not mean sales with a credit card. It means that the sales has a debit to accounts receivable and a credit to the sales account. So this is a credit sales. And if it's a cash sales, then the cash sales take place where you record the entry debit to cash and credit to sales. So the first type that you see, this is called a credit sales, debit to accounts receivable, credit to sales. And the second type is debit to cash and credit to sales. Now, when we are dealing with the auditing chapters, we envision that one business is selling to another business. So for example, Al Rayyan Water Company is selling to Lulu Hypermarket. So Lulu is buying, Lulu is the buyer, and Al Rayyan is the seller. So the transactions that take place are most of the time credit transactions. So Lulu does not pay cash. Al Rayyan records accounts receivable, and at a later time, Lulu pays Al Rayyan. Okay, so most of these sales are credit sales. The second type of transaction we have is returning of goods. Returning of goods are when the customer has purchased something, right? And then they return the item to your client. So this is returning of goods. Now, by the virtue of this transaction, you can understand this type of transactions are not many. All of us have purchased many things in our lives, but how many times do we return something? Not many, right? So this type of transactions are not common, although they take place, right? But they are very few. So far, so good. You can stop and ask me if you don't understand anything, okay? Now, the accounts that are affected because of the transactions, the first one is sales. So you debit accounts receivable and we could credit sales. Anytime you have accounts receivable, you have two other accounts that come with it. One is the allowance for uncollectible, meaning those accounts receivable that you think you're not going to collect, those that are not going to, the percentage of the accounts receivable you're not going to collect cash for. And the bad debt expense is the expense because of those uncollectible items. Now you have seen this, I'm sure, in financial accounting as well as intermediate accounting, right? We are not going to record these entries because we are doing the audit, but the client whom we are auditing, they will record these journal entries. So it is necessary for us to understand what the client is recording. The second type is the cash receipt. So when the cash is received, you debit cash and you credit accounts receivable. You debit cash and you credit accounts receivable. This is when cash is received. And if you have cash discounts, then that is also debited. So you have cash discounts, that is also debited. Okay. So this is the second type of transaction. The third type of transaction is sales return and allowances. Sales returns and allowances or sales discounts, they have a particular name, and let me see if any one of you can remember the name of the type of accounts a sales return is and a sales allowance is. If you can remember, what do we call them? Anyone remembers? Does contra revenue sound familiar with you? Contra revenue. Contra revenue. Contra revenue is this type of account. Sales return and sales allowances, they are contra revenue. So in the income statement, right? In the income statement, the first line is sales. The second line is sales returns. Okay, so this is sales returns are those sales that were returned. So it's subtracted from the sales. And the third line is net sales. Okay, so this is on the income statement. The sales return reduces the sales. That's why it's called contra revenue. It contradicts the revenue. It is going against the revenue. So it reduces the revenue. So sales minus sales returns is the net sales. Clear? Right? You're following? So contra revenue is opposite of the revenue. It is going against the sales. Okay. So those are the three types of transactions and the accounts that are affected because of that. Now we have a set of activities and a set of documents following those activities that the client completes. So the client goes through these activities, and the client goes through completing these documents and records. Remember, we are not present at the client's location when they're selling and receiving payment and recording these transactions. It has already happened in the past. The only thing we can look at are the documents that the client generated. And from those documents, we have to make a conclusion that the items recorded on the financial statements are true and fair. So it is absolutely necessary for us to understand what are those documents, number one. Number two, it is absolutely necessary for us to understand when and in which order these documents are prepared. So what should happen before the preparation of this document? Okay, and which document comes first, and which document comes second, and which document comes third? We have to remember them and we have to understand them. Okay, are you following? So let's try and start the sequence, and you stay with me 120% with 120% attention, because if you can grasp this, you can become not only just a good auditor, but you can become a good accountant as well, inshallah. So the first thing is the order entry. The customer comes and places an order. Your client enters that order. That is the first step. The first document created in this is the customer sales order. So customer placed an order. The customer sales order is created. The customer sales order is created. Along with that comes something called an open order report. An open order report has all those orders that your client has received at a particular point in time, and they have not completed delivering the items in that order. So when you go to McDonald's, for example, in the mall, and they have this screen on top that says preparing order number 254, serving order number 257. That screen is the open order report. Are you following? Anyone, if you have seen that screen? Anyone of you have seen that screen? Sharat has seen. Anyone else? Right? So that is the open order report. So if you have already received the order, would your order be on that screen? If you already received the order, would your order be on that screen? If you already took your item and you went away, would you see your order number on that screen? You would not, right? So if you come to the client and you see an open order report, and the open order report is dated February 11th. So the open order report is dated February 11th, and in that open order report, you find an order that was shipped and delivered on February 10th. That means there is an error in here. This order was already completed the day before. It should have been removed from the open order report, and it's an error if they have not removed it. Okay, so open order report should not have any orders that were completed. This is the purpose of the open order report. The next step is credit authorization. So once you receive the order from the customer, the next stage is credit authorization. Now remember, the credit authorization only happens for a customer the first time they buy from you. Or if they're asking for an order that is larger than your usual order. So the customer is a brand new customer and they want to buy now and pay later. Then your client is going to ask them to provide some information in the credit authorization form, such as bank statement, such as bank account balance, such as references of other businesses from where they have purchased. So this will allow your client to decide whether to sell to this customer on credit. So in other words, can you trust to give the customer the goods and the services and have an accounts receivable from the customer and trust that the customer is going to pay later? If you are feeling comfortable doing that, if you feel comfortable doing that, then you approve the credit. So this is the second step, and it only happens when the customer is buying for the first time, because if they purchased and they paid, then you can sell again and they will pay. So this is a continuing relationship. They buy and they pay, and they buy and they pay, going on accounts receivable, cash received, accounts receivable, cash received, going on, right? Unless there is a special situation where your customer wants a large order, larger than usual, then that goes through a special authorization, and this could be for one time, two times, etc. This is not regular business. So this is the credit authorization process, and the form is called credit approval form. This is the second step. The third step is shipping. So once you have received the order, the credit is approved, or if it's a regular customer, no need approval, they have purchased from you before, then you ship the item. The item is shipped, and the document that is created during the shipment is called the shipping document. The shipping document has all the details of what was shipped, what is the number of items, what is the quantity, the item number, model number, etc., that was shipped. So the shipping document shows the details, the date of shipment, right? And there may be other terms and conditions. So the shipping document. So if there is a shipping document, right? As soon as the shipping document is created and the item is shipped, that means the transaction is complete. Okay. During this process, there is another document that is created, which is called the bill of lading. Bill of lading is a document that is a contract or an agreement between the seller and the shipping company. So let's say you ordered something from a seller and they are shipping with DHL or Federal Express, right, or UPS. There is a bill of lading between the seller and the shipping company. So the seller says, we have given you 3 laptops. The shipping company says, yes, we have received 3 laptops. If something happens during the shipment, then the shipping company is responsible. The seller is no longer responsible. So this bill of lading is the contract between the seller and the shipping company. Who's going to pay for the shipment? Who's going to pay for the shipment? It depends on what the terms and conditions are. You have heard something called FOB, shipping point, and FOB, destination, right? Very good, Sharat. FOB, shipping point, and FOB, destination. Free on board, shipping point. Free on board, destination. Who pays for the shipment if it is FOB, shipping point? Who pays for the shipment if it is FOB, shipping point? Who is responsible for paying the shipping company if it is FOB, shipping point? No, it's not the seller. It's the buyer. So this is the confusion here. Remember this. It is free at the point of shipment. It is free at the point of shipment. So wherever it is shipped, it is free there. Who is at the point of shipment? Who's standing at the point of shipment? Where it is shipped from, who's standing there? The buyer or the seller? The seller. That means it's free for the seller. That means who pays for it? The buyer. So FOB, shipping point, it's counterintuitive. That's why this is a little bit confusing for all accounting students. But remember, this is not, it's very common. You're not the only one. It happened to me. It happens to everyone. But remember, free at the shipping point, meaning whoever is at the shipping point is free for that party. So the buyer is paying when it's FOB, shipping point. Is that clear? So obviously the opposite is FOB, destination, which means FOB, destination is seller is paying. Okay, very good. Once the item is shipped, the journal entry is recorded in the sales journal. The journal entry is accounts receivable debit and sales credit. So you debit accounts receivable and you credit sales. This is the point where the sales journal entry is recorded. Now, if you have a sales journal entry recorded and the date on that journal entry is before the date of the shipping document, that means there's something wrong. there's something wrong. The shipping document must come before the recording of this entry. So very important, okay? The shipment must be done first, and then you should record. So it could be the same date or a day or two later, no problem. But if the sales is recorded before the shipment, right? And the only way you can know the shipment is by looking at the shipping document. So there's a copy of the shipping document, so you know when it was shipped. The sales entry should come after the shipment. Clear? Okay? So you, Mr. Auditor, can verify this. Step number 4 is billing. So this step number 4 happens simultaneously with the shipment. You send a sales invoice, which is basically the bill, to the customer. So your client sends a sales invoice to the customer, and it happens every time they send a shipment. So let's say you have Al Rayyan Water Company sending a truck of water to Lulu every week. So every time they send this truck full of water, they will send a sales invoice every time. Okay. The second item is a customer statement, which is usually sent monthly. It is usually sent monthly, and it has more details than just one sale. Customer statement would show, this would also come from the seller, and it would show that in the previous month, so this would come at the beginning of the month, showing the activities of the previous month. So it will show how many trucks of water were shipped in the previous month. So if it comes in the first week of February, it will show the shipments made in January, the payments that were received from the buyer during January. So the customer statement is more comprehensive. It gives you an overview of the transactions that took place over a period of a month, at a period of time, which is usually a month. Okay, the customer statement is usually for a month. You can stop and ask me. I'm going to continue, inshallah. If you don't understand anything, the difference between the sales invoice and customer statement, I hope, is clear, right? The fifth activity that takes place is cash receipts. So once you send the bill, the buyer will send, right? Your customer will send the money to your client. Once the cash is received, there is something called a remittance advice. Sharat says, is it mandatory to issue customer statement? This is standard practice, right? This is standard practice, okay? It's standard practice to give customer statements. Now, remittance advice is notification of payment. So let's say your customer, the customer of your client, sends a payment. They will send a copy of the invoice back with the payment, which is notification of payment. Or if the customer made an electronic payment into the bank of the client, the bank will send a notification to the client saying that your such and such customer sent a payment and it was received on such and such date and the amount was such and such. Once this notification of payment is received, once the remittance advice is notification of payment. Once remittance advice is received, you record an entry in the cash receipts journal, which is debit to cash and credit to accounts receivable. Okay, so this is recorded once the remittance advice is received. Once the remittance advice is received, debit to cash is made and credit to accounts receivable is made. This is step number 5. Step number 6 is sales return. This again does not happen often. Just you can imagine through your own example to your own self. You know, you have purchased many things from many supermarkets. How many times did you return something, right? Doesn't happen often. But when you do return something, the seller issues something called a credit memorandum. So it gives you either credit to buy something else from them, or gives you cash back, or gives you credit for future purchases. Whatever it is, the credit memorandum is issued by the seller, which gives the buyer the credit for returning the item, either cash uh, or discounts on future purchase, whatever it is, that they have received the item back and you can get something in exchange for that. Okay. Number 7 is updating of accounts receivable. This number 7 step is separated here separately, although it happens for every cash receipt, because we are dealing with the accounts receivable account, primarily the balance sheet account that we're dealing with, which has a lot of auditing activities that you must do. Uh, we need to discuss this a little bit more. Accounts receivable subsidiary ledger is the first item listed here. An accounts receivable subsidiary ledger is a T account that is created for every single customer the client has. So in other words, remember in our examples when we did the audit sampling, I showed you a general ledger where we had an accounts receivable for North Supermarket, and an accounts receivable for South Supermarket, and an accounts receivable for Big Supermarket. Remember those? Those are the customers of the client, and every single customer has an accounts receivable subsidiary ledger. A subsidiary ledger is a sub ledger for each customer. Each customer has an accounts receivable. Now you can imagine the client has, let's say, 300 customers, how easy it is for them to record the transaction of one customer in the T account of another customer. Very easy. So when we are auditing, we have to see whether the items recorded in the T account of one customer actually belongs to that customer and not any other customer. So we randomly check that to make sure that each accounts receivable subsidiary ledger is showing only the transactions for the customer whose subsidiary ledger you're looking at. Is that clear? That's the accounts receivable subsidiary ledger. The second item here is aged trial balance. Accounts receivable is categorized. So you have 30-day-old accounts receivable. You have 60-day-old accounts receivable. You have 90-day-old accounts receivable. The accounts receivable aged trial balance shows the accounts receivables by category. So the older the accounts receivable is, the less chance of collection you have. So the items that are under the 90-day-old accounts receivable, meaning the customer purchased 90 days ago and the customer has not paid, the possibility of collecting that payment is less than the customer who only purchased 30 days ago. So when you are looking at the age trial balance, you can do an estimation of how much the allowance for bad debt is and how much the bad debt expense would be. Okay, so the aged trial balance is prepared by the client, and it shows the accounts receivable by the age of the accounts receivable, 30-day old, 60-day old, 90-day old. Okay, they may have different categories. These are not the only 3 categories. You might have 180-day old, for example. So this is depending on the practice of the client. The third is right of authorization. What is right of authorization? Right of authorization is the permission to stop sending the customer any more bills. So let's say you have a customer that purchased something from your client 6 months ago, and the customer has received 1, 2, 3, 4, 5, 6 invoices, and they have still not paid for that purchase. Now your client wants to write it off, meaning they don't want that accounts receivable on the general ledger anymore. They would record the bad debt expense, and they're going to remove the accounts receivable from the general ledger. This requires an authorization from a higher authority, So it goes to a higher authority, not in the accounts receivable department. And once the higher authority, and we're going to talk about where it goes, when the higher authority says, okay, it's approved, then it's removed from the accounts receivable list, and the client no longer sends invoices to the customer because they have decided that this is not worthwhile anymore. They're not going to pay. Is that clear? Okay. And the last is updating general ledger. The general ledger is the whole, all the accounts, debits and credits recorded in one place. And I'm sure you have seen a general ledger, the one that I showed you, where all the accounts receivable and cash and inventory and all those items, all those accounts, debits and credits are recorded. That's the general ledger. If you took accounting information system with me at any point in time, you prepared a general ledger using wave accounting. You remember what you submitted was a general ledger detailed report, if you remember, right? When you recorded the transactions, you recorded them in a general ledger. Does that ring a bell? Do you remember that? Yeah. So the general ledger is not only updated at the end, but it's continuously updated. Okay, it's continuously updated. Okay. All right. Now we come to the segregation of duties. The segregation of duties. Remember, each one of these tasks that we have discussed are done in the order we have discussed, but they are done by different departments and different individuals. Segregation of duties are beneficial in two big ways. There are many benefits of segregation of duties, but there are two primary benefits of the segregation of duties. The first benefit is that it minimizes fraud. So if multiple people are involved, it is difficult for one person to steal cash without getting caught. The second benefit is when multiple people are involved, it increases accuracy. So if one of the individuals missed something or recorded something incorrectly, someone else will catch it. Okay, so this is the purpose of segregation of duties, to minimize fraud and increase accuracy. So let's go through now. You have to remember and you have to understand. So remember this. Just understanding the logic is not good enough. You have to remember how the duties are segregated. Okay, so let's start. The first is receiving and preparing of orders. So from top to bottom, you have all the functions that we discussed are listed, and from left to right, the departments that do these activities are listed. So the first thing is receiving and preparing the customer order. It's done by the order entry department. Second is approval of credit. It is done by the credit department. Authorizing the credit is done by the credit department. The third is shipping goods to customers and completing the shipment. This is done by the shipping department. Preparing the customer invoice is done by the accounts receivable department, and it's done usually using a software, so the IT department is involved. Updating accounts receivable for sales, so debiting accounts receivable and crediting sales, this is done by the accounts receivable department, and it's usually done in a software, in an accounting software, so IT is also involved. Receiving customer remittance, so receiving the actual amount of cash from the customer, this is done by the cash receipts department. Okay, the cash receipts department is responsible for that. That is true, Sharat. Software is used in order entry and credit and shipping as well, right? But this part goes into the accounting software. Okay, this part goes into the accounting software, which is the final product into the financial statement. All right, are you following? Now we have the cash receipt. It's done. It's received by the cash receipts department. Then we have updating accounts receivable for remittance. So once the money is received, it's received by the cash receipts department, but the accounts receivable department debits the cash and credits the accounts receivable. So you see two different departments are involved, so that cash is handled by multiple, the cash receipt is handled by multiple people. So not one person can hide the money and skip the entry. And of course, IT is involved. And then we have preparing accounts receivable aged trial balance. Again, this is done by the accounts receivable department, and IT is involved. And then we have the authorization of accounts receivable write-off, which is done by the treasurer. The treasurer is the head of anything that deals with money, right? The treasurer is the head money executive, right? So the treasurer approves any write-off. The accounts receivable department cannot authorize it. It has to go to the treasurer. And once the treasurer approves that this accounts receivable should be written off, then the customer will no longer get a bill for that invoice, for that sale. Okay? There's a lot of information here, and you should study this very closely and try to understand and remember. And we're going to talk about how this will come into play. If you know that the cash receipts department should handle the receiving of the cash and the accounts receivable department should record the entry, and you come to the client's office, you come to the client's accounting department, and you find the same person is receiving the cash and the same person is recording the entry, that means there is a problem with internal control. There is a problem with segregation of duty, which increases the possibility of fraud, decreases the accuracy. Okay, so there is a problem. So when you see this, if you don't know what should be separated, then you will not be able to detect this problem. Is that clear? Okay, so this brings us not just cash receipt, Sharat. Treasurer is not anything to deal with cash. Any cash handling in and out, any cash going in and out, the treasurer is responsible. Okay, the cash, any cash flow, right? Any cash inflow or outflow. Very good. The if you look at the dollar bill, you will see that the signature is the signature of the Treasury Secretary, right? The government also has a Treasury Secretary. So you will see the Treasury Secretary, Secretary of Treasury's signature on every single dollar bill. Okay? Okay, so this brings us to the end of what the client does. This brings us to the end of what the client does. Now, if you can understand what we discussed, and if you can remember and understand and follow along, then this what we are going to study is not only just going to make you an auditor, a good auditor, but it will make you a very good accountant. And I want to show you an email that I received from one of my students just a couple of months back. This student was an auditing 2 student. The student uh, you know said, if you come here down at the bottom, it says, the auditing 2 course I took with you was really helpful and I could answer assertion related questions and other QA very well. So this what we are studying right now, what we have studied and we're going to study in this course, is not only going to make you, this is not only, book knowledge that will help you answer exam questions, right? Answering exam questions is a temporary benefit. This will no longer be a benefit 3 months from now. But if you can understand, if you can allow me to teach you, and if you can learn from me, inshallah, the details of how it works, how the actual accounting and auditing works, right? Then this will actually make you a very good accountant. Sharat says, I talked to him yesterday and he said the same. He asked me to prepare for interview based on this course, right? So very good. So this, when I get an email like this, and alhamdulillah, I get a lot of emails from my former students. They're in different areas of practice, and they ask me for advice. They tell me about their success and so forth. And this is a big blessing. It's a blessing on me. It's a ni'mah from Allah on me that I have this from my students, and I'm going to be at your service, lifelong, as long as Allah gives me tawfiq. I have students coming with issues they're having at work, and how to handle them and so forth. And I am here to help you. So I learn from my students new things that are going on in the industry and so forth, and they learn from me. So it's a continuous relationship. My relationship with you is not going to end at the end of this semester, inshallah. It will continue for as long as Allah allows us to continue. As long as you would like to come back to your old professor for help, inshallah, I am going to be at your service, inshallah. Okay? So the reason I'm showing you this is one particular special reason. That is, you see this word assertion, the word assertion here. I'm going to discuss assertion next. And it is very, very important that you understand and internalize what this assertion business is, because this will not only make you an auditor, it will make you an excellent accountant. Okay, you're going to be on top of your game. Okay, so let's start. We're not going to finish, obviously, but we're going to start, and we will continue, inshallah, next week. So assertion, what is assertion? What does the word assertion mean? The word assertion is coming from the word to assert. Assert means to give some type of guarantee, to give some type of promise. And you have seen people speak in a non-confident way, meaning you ask some people that, have you done this? They say, I'm not sure, maybe I did, maybe I didn't. Or if you ask them a question, they say, hey, maybe this is correct, maybe this is not. That is not assertive. Assertive is when somebody talks with confidence, that you ask some people a question and they are sure. If you ask them, are you sure this happened? They will say, yes, I've seen with my own eyes. Are you sure this is the time of the class? Yes, I'm sure. Are you sure that this is what we have to wear? Yes, I'm sure. So they know with certainty, with guarantee, the material. All right, that's assertion. Management assertions are certain guarantees that the company that you're going to audit, is going to give you. Okay, the management assertions are those assertions, the guarantees that the client's management gives you about the financial statements. And these assertions are in three different categories. The first category is transactions and events. The second category is balances at the end of the period. And the third category is this presentation and disclosures. Presentation and disclosures. So the first category is transactions and events. We're going to talk about the first two categories, first two items under the transactions and events. Are you with me? Are you on the same page? Are you there? Are you awake? Are you awake? Are you listening to me? Are you playing with your phone, looking out the window, eating your breakfast? Are you with me? Are you there? Let me see. Let me hear you. Okay, very good. Now, occurrence. What is occurrence? The client says everything that we have recorded happened. everything that we recorded happened. So if you go to the client's journal and you find debit to cash and credit to sales, this is what they have recorded. You want to see did it actually happen? The client says yes. How can you prove that? If a sales happened, you will have a sales order, you will have a shipping document, you will have a sales invoice, you will have cash that was received. All of those things you will find. That means it actually happened. So the client says, if we recorded something, it occurred, it happened. Everything we recorded happened. If you go into the client's general ledger and you find a sales recorded, but you cannot find a sales invoice, you cannot find a sales order, you cannot find a remittance advice, you cannot find a shipping document, you cannot find anything about the sales, and they said the sales happened. That means you cannot verify the sales. That means the management assertion is violated. The management assertion is violated. You find the transaction recorded, but there is no evidence that it happened. That means the management assertion of occurrence has been violated. Okay, so when you test the occurrence, either you can confirm that they followed, or you can confirm that they did not follow, which means they have violated the occurrence. Is this clear? Occurrence is the guarantee. Occurrence is the guarantee that everything that is recorded actually happened and there is no bogus recording on the financial statement. This is the first. The second one is completeness, which is the opposite, meaning everything that happened was recorded. Everything that happened was recorded, meaning the client says that you will not find a shipping document and a sales invoice and a sales order except that we have recorded a sales entry in the journal. So anytime you pick up a sales invoice or you can pick up a sales order or shipping document and you say, well, was this recorded? The client says, yes, it is. So that means the whole thing was completed. This is the management assertion of completeness. Anything that happened was recorded. This is the opposite. So if you want to test occurrence, you first go to the transaction. You pick up the debit and the credit and you go back and see, do I have a sales order? If you want to test completeness, you pick up the sales order and you go forward and you see, well, do I have an entry in the general ledger for this sales order? Is that clear? These are the first two. Okay? Is this clear? Do you understand the first two management assertions? Right? Occurrence is anything that happened, anything that is recorded happened. Completeness is anything that happened was recorded. So in occurrence, if you find a journal entry, you will find the documents that came before the journal entry. That means it happened. In completeness, if you have a document, you can go and find the journal entry in the financial statement. Okay? Is that clear? All right, so we'll stop here, inshallah. Please listen to this lecture. Please watch this video before you come back on Sunday, because we're going to run with these assertions on Sunday. All right, I'll see you then, inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.